Owen's here with the business, then he's got a flat opening today. I don't think it's anything to do with property. I think it's more to do with the markets, isn't it?
It certainly is, yeah, coming off some of those highs from, well, basically the beginning of the week, Stuart. All the European markets opening, as you say, pretty flat territory right now. Look out for the CAC 40 to see how the markets here in France, of course, respond to that jobs summit that Elena was talking about just a moment ago. Of course, plans there to bring in a new social VAT tax, pushing up VAT rates, which many investors will no doubt be a little bit worried about. Let's take a look at the Asian markets as well. A reasonable day's trade there for the Nikkei, finishing the day around 1% in the green. You can see the Hang Seng recovering some losses. It's been pretty choppy over in that part of the world today. Just worth noting as well, while we're talking stocks, Apple setting a new record for its share price, $424 per share. This company is unstoppable right now, and there's lots of other stocks like that doing very well in places like the US and giving the markets a bit of a lift right now.
OK, so as Owen said, the markets seem pretty unfazed about the latest twists in the Eurozone crisis, and yet the spectre of Greece becoming the first EU member to default on its debts has been raised by its Prime Minister. He says if private bondholders aren't willing to accept bigger losses on their investments, he may force them to. That could trigger an economic collapse, though, as Catherine Viette reports.
Anger on the streets. Thousands turned out to demonstrate against government austerity measures in Athens. The protest comes as cash-strapped Greece negotiates with international creditors over a deal to cut its debt in half. The Greek government wants to swap out maturing debt for new lower-yielding bonds and a small cash payment. The stumbling block has been the interest rate offered on the new bonds, which could take investor losses well over the 50% originally discussed in the voluntary write-down. Without a debt swap deal, the EU, IMF, and European Central Bank, known as the Troika, won't release the next tranche of bailout funds. Money that is desperately needed to pay 14.5 billion euros worth of bonds coming due on March 20th.
The next installment, in many ways, it's a mega installment. It's a do or die installment. So in many ways, this is a very crucial talks, which will encompass not only the progress that Greece has made with the various reforms and objectives, but also its ability to fulfill the deficit targets.
Without the 130 billion euro aid package, the country risks going bankrupt, triggering a messy default and perhaps exiting the Eurozone.
In context there, Stuart, of course, Greece has long been now, well, certainly for the last 3 years, really the number one economy to worry about, and of course the economy that's likely to go to the wall first. Why? Because its borrowing costs are simply unsustainable. Look at the yield on 10-year bonds, of course the benchmark for any country's borrowing, up to 33%. To put that in context, that means for every euro that the government lends out, it's paying 33%, nearly a third of that, on interest payments alone all the time, while the actual value of those bonds actually now plummets. They're pretty much worthless right now. So you can see the debt simply stacks up and up and up. And the problem right now is those negotiations are foundering with private bondholders about how much of that debt should be written off. Now, we hear different figures, and you'll hear different figures this week as they have this horse trading over how much they should write up. 50%, maybe more. There's talk now of even writing off maybe as much as 65% of the value of those things, and it all depends on just how much they're willing to lose, essentially, how much they're willing to trade off in return for getting maybe some longer term investments that might give them a decent return over the long term. But I say the long term, many investors right now won't look past a month or even a week for Greece because they think this country will simply default before they get their loans back. The aim, of course, with all this is to bring down that public debt to around about 120% of GDP. Now, that's staggering by any measure, and yet that might just be manageable for this country when you compare it to, say, a country like Italy, which has similar public debt levels and has so far managed to avoid a default, but only so far.
Well, scary figures, aren't they? But a default, a lot of people say, necessarily doesn't mean the end of Greece in the euro.
Yeah, this is a legal thing that, of course, is being wrangled over right now, and everybody seems to say, yes, Greece will have to leave the EU, will have to leave the euro, but in fact, Greece could actually have what's known as a technical default default. It could actually default on some of those loans and yet still stay in the EU, still stay in the euro. If it's managed, that means that if the economy simply just doesn't collapse, if there isn't a run on banks, maybe social disorder and all those sorts of things. The problem now, though, is you're getting some very threatening language. We've heard just in the last few hours, the Greek Prime Minister, Lucas Papadopoulos, as you said there in your introduction, he may force investors to take down those write-downs. Well, that's pretty tough language from the Prime Minister, the kind of thing that might make bondholders say, well, we know what, we'll let Greece go to the wall after all and simply cash in our investments.
OK, let's have a look at a few more of the day's business stories then. And the World Bank has cut its global growth forecast by the most in 3 years. The organisation says the world economy will grow just 2.5%, more than 1% lower than a forecast just 6 months ago. It's also warning that the euro area will now contract by nearly 0.5%, having previously forecast growth of nearly 2%.
And Samsung has denied it's looking to buy BlackBerry maker Research in Motion. The South Korean firm, now the world's second biggest mobile phone maker, says it's also not interested in using RAM software in a licensing deal. The denial nevertheless helped drive RAM stock higher in US markets. It lost 75% of its value last year as BlackBerry lost huge market share to Apple. Now, you might remember Yahoo. I certainly vaguely remember, but I have to say, I stopped using Yahoo largely around the time when Google came to be one of the biggest internet sites in the world. In fact, Yahoo's co-founder, Jerry Yang, was building that internet site when Google was just a dream in the eyes of two undergraduates. But its star has fallen in the era of Facebook and indeed the growth of Google. And Yang's departure is the latest chapter in one of Silicon Valley's most turbulent recent histories.
He's chief Yahoo no longer. Jerry Yang, Yahoo's co-founder, has quit the company he started 17 years ago. His sudden resignation comes 2 weeks after Yahoo appointed Scott Thompson to be its new CEO. Yang founded Yahoo with David Filo in 1995 while he was a student at Stanford University. Once an internet pioneer, Yahoo now struggles to compete with Google and Facebook for users and online advertising dollars. In recent years, Yang has come under fire for mishandling the company's affairs. He stood in the way of a 2008 takeover attempt by Microsoft, angering shareholders. Before the dot-com bubble burst, Yahoo was valued at $100 billion. Today, the company is worth about $19 billion. Wall Street reacted favorably to the news, with the company's stock price gaining 3%. Analysts say Yang's departure may pave the way for the company to sell some of its assets, including a 40% stake in Chinese e-commerce giant Alibaba.
That's your business then. Don't forget, of course, Owen's on Twitter. You can follow him on there if you get a chance to have a look at his Twitter page. And we're back really, really shortly with the latest headlines with Claire here on France 24.